is on foreign exchange. So nominal exchange rate, number of units of domestic currency required to purchase 1 unit of foreign currency. And the next is real exchange rate, relative price of two currencies after adjusting for the price levels in those two nations. Nominal effective exchange rate, NER. NEER, nominal effective exchange rate, the weightage average of nominal exchange rate where weights are the share of trading partner in the foreign trade of the country. Real effective exchange rate, REER, the weightage average of real exchange rate with weights are the shares of the country in foreign trade. Another is exchange rate determination. Initially, the exchange rate is determined by the market forces of demand and supply. After a certain stages, the central bank of the economy intervenes. Demand for dollars, when dollar price of rupee falls, implying that rupee appreciate, then import increase and demand for dollar will increase. Supply of dollar, when dollar price of rupee falls, this will discourage the import and hence supply of dollar decreases. Here you are seeing a diagram that represent the exchange rate determination. On the x-axis, number of US dollar, and on the y-axis, dollar price of rupee are taken. Two curves you are seeing in this diagram. First is demand curve and second is supply curve. Demand curve is downward sloping and supply curve is upward sloping. You are here seeing here the intersection point is the equilibrium point that identify the exchange rate of the US dollar in a certain prices. How will exchange rate be determined? Exchange rate determination will be, we can make by the demand and supply of the currency and the availability of the currency in the marketplace. So here you are seeing the shift in demand supply curve from downward. So the price or the amount of currency also shifts as the equilibrium point you're finding here, you're seeing is also shifts from upward to downward. Okay, when the price of dollar is 5, the demand is high or equilibrium point is at the higher level, and when the price decreases from 5 to somehow 4, the demand for dollar is increased as from 3 to number of US dollar increase from 3 to 4. This is the exchange rate determination. When price falls, this number of US dollars demand will increase. Okay, this diagram can be explained as domestic interest is greater than world interest rate. Capital inflow in the economy, supply of dollars increases, supply curve shifts rightward, and dollar price of rupees decreases, implies that rupee appreciate as domestic interest rate is greater than world interest rate. When you are taking money from outside, So domestic interest rate is greater than world interest rate. Then capital inflow in the economy. The capital inflow will be in your economy. And supply of dollar increases. We are increasing the supply of dollar. Okay. And supply curve shifts rightward. The supply curve you are seeing here, it shifts rightward. Okay. Dollar price of rupee decreases, implies that rupee appreciates. When dollar price decreases, it means rupee is in appreciation condition. Okay. Next is exchange rate determination. When supply demand curve shifts upward, it means domestic interest rate is less than world interest rate. And capital outflow. Demand for dollar increases. We are seeing here the demand curve shifts upward. Demand curve shifts upward. Okay. And rupee depreciates and dollar appreciate. Rupee is appreciate, rupee depreciate and dollar appreciate. Fine. On the y-axis, you have taken dollar price of rupee. Next, Mundell-Fleming model, that is also known as ISLM-BP model, and was given by Robert Mundell in 1963 and Fleming in 1962. The assumption of this model is to small open economy, perfect capital mobility, domestic and foreign bond are perfect substitutes, tax rate are same everywhere, perfect equalization of returns in different countries, foreign investors do not face political risk, fixed foreign or world interest rate. So the policies that affect, first is fiscal policy, the second is monetary policy. Okay, in the curve, fiscal policy. In case of fixed exchange rate, expansionary fiscal policy leads to rightward shift in the IS curve. Okay. And as a result, there is fall in price of dollars in terms of rupee, leading to outflow of foreign currency. So to keep it constant, the central bank increases the money supply and hence shifting the LM curve to the right and restoring the equality between IS, LM and balance of payment curve. Therefore, fiscal policy is more effective in case of fixed exchange rate. In case of expansionary monetary policy, the LM curve shifts upward towards the right. This makes the domestic interest rate to fall below. Okay, flexible exchange rate. In this flexible exchange rate, the role of export plays a very important role. The fiscal policy is applied in the flexible exchange rate scenario, then expansionary fiscal policy will shift the IS curve upward. And currency operations appreciates, then import increases and export decreases. IS curve shifts back, making the fiscal policy ineffective. In monetary policy is effective in the case of flexible exchange rate. Expansionary monetary policy shifts the LM curve downward, implying increase in the money supply. Currency depreciates, imports decreases and export increases. IS curve shifts upward, making the monetary policy effective by bringing a rise in the income level of the economy. Rate U confidence level now should be 8 plus. That will be sprint confidence ratio. Rating scale from not going to happen, getting worried, not sure, probably okay, you're confident and happy. These are the rating scales. Okay. Now, in this foreign exchange market, foreign exchange, you have seen some of the basics of foreign exchange. When it affects the market, when it affects the fiscal policy and monetary policy. Now come on another point, that is foreign exchange market. This market is a market where dealing in foreign currency takes place. It may or may not be physically located. So functions of foreign exchange market are transfer function, credit function and hedging. How foreign exchange market transfer the purchasing power of people. This is the transfer function of foreign exchange market. And credit function, providing credit to exporters and importers. Hedging, protection against foreign exchange risk. The operators or elements in foreign exchange, that as users of foreign exchange commercial bank, they act as clearing houses. Brokers, they can commission on buying and selling of foreign exchange, and the foreign exchange operations will be by central bank. Okay, kind of operation: spot transaction, forward or future transaction. Spot transaction, payment has to be made within 2 business days. And forward or future transaction, signing an agreement for payment on delivery in future. Activities in foreign exchange market. The activity will be on the basis of hedging, protection against foreign exchange risk. Hedging is also known as protection against foreign exchange risk. In these types of risk, transaction exposure due to fluctuations in the rate of foreign exchange market in future market, accounting translation exposure interprets account in terms of different currency to accommodate balance of payment value. Inventory is held abroad in terms of own domestic currency for inclusion in balance sheet. And then economic exposure estimate domestic currency value of future profitability of the firm. These are the types of risk and in the foreign exchange market that will relate with the hedging. Speculation or speculators. It is the opposite of hedging, more in forward market. The speculators are willing to take risk or take an open position. The activities are stabilizing or destabilizing or arbitrage. By stabilizing, buy currency at a low price, expecting that the price will higher in the near future, and sell the currency when the price is higher, expecting that it will be lower in the near future. Destabilizing, buy currency at a higher price, expecting that prices are going to be higher in near future, and sell it when the price is lower, expecting that price will get lower in the near future. Then arbitrage, it is a tool to equalize the price, buying the currency from a country where price is lower and immediately reselling it in a country where it is higher in order to earn monetary benefits. Purchasing power parity. The concept was given by Gustav Cassel in 1918. It is the law of one price. The situation occurs when all the opportunities of arbitrage are exploited and we reach a single price. In the long run, law of one price prevails, that is, one price for same good will prevail in all the nations. Optimum currency area. The theory of optimum currency area was developed by Mundell and McKinnon in 1963 or 1960s. It is a group of countries whose currencies are permanently tied and will vary with non-members. It refers to an optimum geographical size within which means of payment is a single currency and exchange rate are pegged to one another with unlimited capital and current accounts. On the balance of payment, but whose exchange rate fluctuate in unison against the non-members, possibility or condition in which it will be beneficial. Greater mobility of resources among member nations, greater structural similarities. Countries should be more willing to coordinate their monetary and fiscal policies. Properties of optimum currency areas, that mobility of factors, price and wage flexibility, economic openness, diversification in production and consumption, similarity in inflation rates, fiscal and political integration, goods and factor market integration, financial market integration, and then benefits of optimal currency area. Eliminates the uncertainties regarding exchange rate, specialization in production, increase trade volume, advantage of economies of scale, greater price stability, better use of monetary as a medium of exchange and store of value, saving the cost of official interventions in the forex market. And their drawback is nations cannot pursue their independent monetary and fiscal policies. So these are the condition of foreign currency market or foreign exchange market. So you need to understand the functions of foreign exchange market, operation or elements in foreign exchange, kind of operations, spot transaction and forward or future transaction, activities in foreign exchange market, that is hedging, speculation in hedging, types of risk, transaction exposure, accounting transaction exposure, and economic exposure. You need to focus on these points. Speculation or speculators, their activities, that is stabilizing, destabilizing, and arbitrage. Then purchasing power parity, the theory of purchasing power parity, that will help to understand the foreign exchange market. Optimum currency areas, possibility or condition in which it will be beneficial, properties of optimum currency areas, benefits of optimum currency areas, and its drawback. Another related points of that foreign exchange market are that are sorry that are the foreign exchange markets that represent the different labels of the foreign currency exchange rates. Thank you. I have also discussed some of the points of foreign exchange market here. These are exchange rate determination. Here are the points that are foreign exchange, nominal exchange rate, real exchange rate, nominal effective exchange rate NEER, real effective exchange rate REER. Exchange rate determination. How will exchange rate be determined? And the diagram can be explained for the domestic interest rate is greater than world interest rate, and the diagram that can be explained as domestic interest rate is less than world interest rate. and the Mundell-Fleming model for the determination of exchange rate in the fiscal policy and monetary policy, label and flexible exchange rate. When explanatory fiscal policy, which shifts the IS curve approach, and when monetary policy is effective in the case of flexible exchange rate, explanatory monetary policy, which shifts the LM curve downward, implying increase in the money supply. So these are the conditions of exchange rates. Okay, so you can easily understand all the topics of foreign exchange rate, determination of foreign exchange rate and foreign exchange market in this slide, in this lecture. Thank you.